back to Iron Financial. This is the place where we forge stronger portfolios, and we do that by putting company reports on the anvil and just hammering away. Today, we've got the industrial giant Eaton. They just dropped their Q4 2025 earnings, and folks, it is a fascinating story. You've got incredible strength, you've got some real points of strain, and you've got a massive strategic overhaul happening right before our eyes. So we're going to get our tools out, we're going to stress test this report, and figure out if Eaton is building its future on solid bedrock or on shifting sand. Let's get into it.
All right, look, let's just get right to it. No beating around the bush. This company, Eaton, has been around for over a century. We're talking since 1911. They made parts for the Model T Ford, for crying out loud. And here we are in a market that is absolutely obsessed with the next big thing: AI, cloud, tech that's supposed to change the world overnight. So you have to ask the hard question. Is this just an old-school industrial company trying to slap a new logo on and pretend it's a tech darling? Is this a real fundamental transformation we're seeing, or is it just a fresh coat of paint on a very, very old and rusty frame? That's what I'm here to find out.
And we're going to walk you through every single piece of it so you can make that call for yourself. So here's our blueprint for today. First up, we're going to ask, is Eaton really built for tomorrow? We got to understand the machine itself. Then we're putting the Q4 numbers under a high-powered microscope. After that, my favorite part, the segment stress test. This is where we see which parts are firing on all cylinders and which ones are just dead weight. From there, we'll get into management's grand plan for forging the future. Then we'll look at the dividend, which for many is the bedrock of this whole thing. And finally, we will deliver the Iron Financial verdict. Okay, let's dive right in.
All right, Section 1. Is Eaton really built for tomorrow? Before we even touch the latest numbers, we have to get a handle on what this company actually is today. Not what it was 10 or 20 years ago. Where is it placing its bets for the next decade? That's what matters.
You got to understand, a company doesn't survive for more than 100 years by accident. It's not about standing still. It's about evolution. And you can see it right here. They start out making truck axles. Then they move into hydraulics. But the real game changer, the moment that defines the company we're looking at today, was 2012. That's when they bought Cooper Industries and made this massive, all-in bet on electrical power management. And honestly, everything since then flows from that decision. So fast forward to today. The conversation is no longer about gears and pistons. It's all about plugging into these massive, once-in-a-generation megatrends: electrification, the shift in how we get our energy, and of course, digitalization. They're trying to position themselves right at the heart of the things that will power our future: the data centers, the grid upgrades, the whole EV charging network. So no, this is not your grandfather's Eaton anymore. Not by a long shot.
Okay, a great story is one thing, but you know us here at Iron Financial. We trust the numbers. Hard numbers are another thing entirely. So now, it's time to see if the performance actually matches the narrative. Let's get to the report card and see what the financials are really telling us.
So let's start with the big one, the headline number everyone looks at first: adjusted earnings per share. It came in at $3.33. Now the key here is that this was right on the money. It was exactly what analysts were expecting. And in a market this volatile, just doing what you said you were going to do is a huge sign of strength. It tells me that management has their hands firmly on the wheel. They're not getting tossed around by the waves, they're steering the ship. No drama, no negative surprises. So far, so solid.
But here's where it gets really interesting. It's not just that they hit the target. Look at the growth. We're not just talking about meeting an expectation. We're talking about crushing last year's performance. An 18% jump in year-over-year earnings is absolutely huge. Think about that. This isn't some sleepy, single-digit growth. This is the kind of explosive earnings power that tells you the business is operating incredibly efficiently. They're turning their sales into pure profit at an impressive clip. This is a very, very powerful signal of underlying strength.
Whoa, let's pump the brakes for a second. Let's not get carried away with the earnings number. That's great, but you have to ask, where is that profit coming from? Because when you look at the top line, the sales, they actually missed. Now, yeah, it looks small, less than 1%, but a miss is a miss. And for me, that's the first potential red flag, the first little hairline crack in the foundation. It makes me wonder, is this impressive earnings growth coming from a booming business, or is it coming from aggressive cost-cutting and, financial maneuvering? If the demand is really as strong as they say, why couldn't they hit their sales number?
Okay, that is a totally fair challenge. A quarterly miss is something you have to look at. But you can't just stare at one brick and ignore the entire fortress. You have to zoom out and look at the structural integrity of the full year. And what a year it was.
I mean, that tiny revenue miss just gets dwarfed by these numbers. We're talking about records across the board. Record sales, up 10% to over $27 billion. Record adjusted EPS, up 12%. And this is the part I love. Look at the cash. Record operating cash flow. Record free cash flow. This is not a company that's just squeaking by on cost cuts. This is an absolute cash-generating machine running at an all-time high. This is the solid foundation that everything else is built on.
All right, so the big picture looks pretty darn solid. But now for the real test. Now we take the whole thing into the workshop. We're going to pop the hood, we're going to take the hammer to the individual components, and see how each part of this engine is really running. Because the overall numbers can hide a lot. This is the segment stress test, where we find the real pillars of strength and the real points of weakness.
And wow, this one chart tells you almost the entire story, doesn't it? It is immediately crystal clear where the power in this company is coming from. Just look at that huge blue slice, Electrical Americas, growing at a blistering 21%. That is the main engine, full stop. Then you've got Aerospace, a powerful secondary engine, firing strong at 14%. Electrical Global is chipping in a solid 10% too. But then you see the drag. The old legacy vehicle business is pulling things back, down 9%. And that much-hyped eMobility segment? Down even more, a whopping 15%. The picture couldn't be clearer. Electrical and aerospace are doing all the heavy lifting here.
Exactly! And my eyes go straight to the red ink. This is what I'm talking about. Let's really dig into that 15% collapse in eMobility. This was supposed to be their ticket to the future, right? Their big pivot into the EV revolution? Management couldn't stop talking about it for years. But a double-digit decline? That screams that there is a serious fundamental problem. The report blames EV rollout delays, but come on, that raises a huge question about their whole strategy. Did they bet on the wrong technologies? Are they just getting outmaneuvered by competitors? And then there's the old vehicle business, still a big chunk of the company, just steadily shrinking. You've got two segments actively fighting against the growth in the good parts of the business. This isn't just a drag, it's an anchor.
I hear you on the anchor, I really do, but you're so focused on it that you're missing the sheer overwhelming horsepower of the engines pulling this entire ship forward. Let's look under the hood of those growth segments for a second. The demand isn't just strong for a quarter, it's structural, it's accelerating. We're talking about a record backlog, that's confirmed future orders, up a massive 18% in electrical and 15% in aerospace. And check out the book-to-bill ratio, 1.1. Think about what that means. For every dollar of product they shipped out the door, they booked $1.10 of new orders. They literally can't make this stuff fast enough to keep up with demand. This isn't hope. This is a contractually obligated pipeline of future revenue that is directly tied to the biggest build-outs happening on the planet right now, AI and data centers.
Okay, so we've got the diagnosis. The growth engines are absolutely roaring, but there's a heavy anchor from those mobility businesses dragging behind. So that brings us to the most important question of all. What is management going to do about it? What's the plan? Let's take a look at their blueprint for forging the future.
And you can hear it right from the CEO's mouth. Paulo Ruiz lays out the entire strategy in this one quote. Read between the lines here. Notice what he's not talking about. He's not talking about fixing the old vehicle segment. He is laser-focused on the big prizes, the generational opportunities. AI, bringing manufacturing back, massive infrastructure spending. This isn't just some generic corporate fluff. This is him pointing to the horizon and telling everyone, our future is over there, not back where we came from. It's a clear signal to pour all their resources into the high-growth areas.
And let me tell you, these are not just words on a page. They are backing it up with massive, decisive action, and they are moving at lightning speed. This isn't some minor tweak, it's a complete overhaul of the company. Look at what they did in just a few days in January. Bam, they acquire Ultra PCS to get even bigger in the booming aerospace market. Then, 3 days later, bam, they announce they're finally cutting that anchor loose, spinning off the entire mobility group. And then, before you can even catch your breath, bam, they announce another huge deal to buy Boyd Thermal, diving headfirst into the absolutely white-hot market of data center cooling. They are literally rebuilding the company in real time.
Aggressive is one word for it. Risky is the word that comes to my mind. Let's be perfectly clear about what's happening here. They are taking their two worst-performing businesses, packaging them together, and basically kicking them out the door. It's a smart way to clean up the portfolio, I'll give them that. But the execution risk is just off the charts. Think about it. While they are performing this incredibly complex corporate surgery to spin off a huge division, they're also trying to digest two other major acquisitions at the same time. We have seen company after company stumble and fall when they try to do too much at once. This is a very, very high-wire act.
And what does management say to all that risk? Well, their answer is right here in their forward guidance. This is them putting their money where their mouth is. This is their vote of confidence in their own plan. Despite all that complexity, they're guiding to a powerful 7 to 9% organic growth next year. They're targeting a big step up in EPS, and they're projecting that their margins are going to stay incredibly strong. When a management team puts out numbers like these in the middle of a massive transformation, they're sending a clear message to the market. Yeah, we know it's complicated. We've got this. And here are the numbers to prove it. This isn't just a forecast, it's a declaration.
All right, so we've talked about all this change, all these moving parts, acquisitions, spin-offs. It's a lot to track. But through it all, there's been one thing that has been an absolute bedrock for investors, one pillar of stability, and that is the company's commitment to the dividend.
I mean, just look at this. More than a decade, every single year, they have increased the dividend paid out to shareholders. Through good times and bad, through market craziness, through recessions, they just keep raising the payout. A company cannot do that unless its underlying business is an absolute cash machine. It's a direct reflection of that powerful free cash flow we saw earlier, and it's a testament to incredible financial discipline and confidence in the future.
Okay, fine. I can't argue with this. The dividend is a rock. For a lot of people, it's the main steel beam holding up the whole investment case. You can see it right there, steady, reliable, growing every year. It's impressive. But, and this is a big but, a steel beam just holds the building up. It doesn't make it any taller. A dividend is a safety net, not a growth engine. If this whole grand, risky strategic overhaul doesn't deliver the growth they're promising, the dividend is going to feel like a very small consolation prize while the stock price is falling. It reduces the risk, sure, but it does not eliminate it.
All right, we've laid out all the pieces on the table. We have hammered on the numbers. We've stress-tested the different parts of the business, and we've examined the blueprint for what comes next. Now it is time to weigh all the evidence, balance the bull case against the bear case, and deliver the iron financial verdict.
So let's break it down one last time. The bull case, the argument for being optimistic, is built on this foundation of undeniable strength. You've got record margins and a backlog that is just bursting at the seams, promising future revenue. You've got a management team making a smart, decisive pivot into the biggest growth trends on the planet, and it's all supported by that rock-solid growing dividend. But on the other side of that coin, the bear case sees the cracks in that very same foundation. You can't just wish away the drag from those legacy mobility businesses. You absolutely cannot ignore the massive execution risk of trying to juggle a spin-off and 2 huge acquisitions all at once. And let's be honest, the stock has already had a monster run. How much of this good news is already baked into the price? And that little revenue miss, it still lingers, making you wonder if the growth story is really as bulletproof as it seems.
So here's the bottom line as I see it. Eaton is a company that is actively, aggressively reforging itself. It is shedding its old identity and building a new one specifically designed to capitalize on the biggest economic shifts of our lifetime. The risks of doing that are very real, and you're right to point them out. But the evidence of that deep structural demand in their core businesses, that record backlog, is just incredibly powerful. And so, ultimately, the question you, the investor, have to answer is this. Do you believe this management team can pull off this incredible high-wire act? Is Eaton a re-engineered industrial powerhouse that's about to become a cornerstone for any modern portfolio? Or is it a company taking on way too much risk at just the wrong time, making it a potential trap? The parts are all there on the factory floor. The blueprint is in your hands. Now, you have to decide what you think they're building.